one big domino fall, right? You don't know who's below that, just, die.
Welcome back, everybody, to episode 22 of the Backwater Pod. Can't believe we already made 22 episodes and still going on strong. So remember to help click that cute little like button on the way out. But anyway, I think in today's financial market, it's getting crazier by the day. So this time around, everybody is speculating that there's going to be another financial crisis like the '08 crisis. So this time around, flooding or inundating all the headlines is this idea of bank collapse, namely Silicon Valley Bank and Silvergate. So what exactly happened? And right after the collapse, the stock market essentially rallied after the recent CPI reading. So what's going on? Bunti, maybe you want to share with the audience what's exactly going on with the bank collapse.
Yeah, I think last time we used to joke, right? Like during a war period, now everyone become the war specialist. Then I think just last week, right, all of us, I mean, not just four of us here, including others as well on Twitter, on YouTube, like everyone become a banking expert. So now I'm the banking expert now.
It's okay. Honestly, I've never heard of Silicon Valley Bank before this whole thing imploded.
Yes. Same for me as well. I haven't heard of this bank before because apparently, okay, these are all research done after the collapse. So don't treat us like a specialist or expert in this area. So what happened is that there's this bank called Silicon Valley Bank. Is considered one of the largest bank also because it's like if ranked by the assets, right? It's like top 20 largest bank in US. And then they are very active on the West Coast, meaning they tailored for the startup business and so on. So what happened is that they last week, I think they announced that they're going to do a capital raise, and they announced that they already sold most of their available for sale securities. And then that they try to get some funding because they have some problem with their financials. But the fundings wasn't successful. And then basically they just collapsed. What happened is that the government already took over the banks because they want to protect the depositors. So what happened now is that if you are the depositor of the banks, you can still get your money back. But for shareholders and for debt holders, basically their capital just wipe up, like becomes zero. So I think this bank since last Friday, no longer trading. So even if you have the shares you want to sell to someone else, like it cannot be done already. It's already wiped up. Yeah. So that's what happened in short.
Right. And I think Kelvin also made a video specific to this entire SVB collapsing, right? Like, do you have any thoughts or learning points or insights from your research and understanding of the collapse?
Learning points, I guess the banks, I have no idea why they are doing such risky move. Like, why are you investing in a 10-year? I guess even the experts can't foresee that the Fed is going to raise interest rates so fast and furious. One interesting fact is that I found out that one of the management from Lehman Brothers went to join the Silicon Valley Bank. So I don't know if that has anything to do with it. But the good thing is the Fed came in to save them, like what Bunti mentioned. Though they mentioned that this is not a bailout and this won't cost taxpayers money. But I don't really know how these whole things work. Do you all know what is going on?
Hey, I can explain two parts. The first one, right, is like why they go and buy all these long-dated bonds. So I think this one, you need to understand the history of what happens in the past, let's say a couple of years for Silicon Valley banks. The first one is that during, let's say from 2019, 2020, and 2021, all these startup tech companies, they get a lot of fundings, they raise a lot of capital. And it's not like they raise capital enough for 6 months, they just keep on raising. It's not like that one. Some of them, once they raise the capital, it could be, like enough for them to go on for like 3 years, 5 years, and then they will raise another capital later on if needed. So what happens is that they raise a lot of capital, they put into the banks, and then basically just earn interest, right? So that's how they operate. What happened in the recent, I would say 1 year is we know that Fed already raised the interest rate by a lot. And then basically the entire capital markets become very tight. And it's very hard for all these startups to continue to raise money. So if you look at aggregate deposits, right, it went down for, I think, quite a number of consecutive quarters. So deposit came down. So that's why when deposit came down, Silicon Valley banks, they have a lot of deposits. They have to pay all this withdrawal. And that one is one of the reasons that caused the problem. But we rewind back again, back in, let's say, 2020 and 2021, when they have all these deposits, right, they because depositor put money with your banks. You need to invest this money. If not, you are not going to generate enough returns to pay to your depositors, right? I mean, to pay the interest. Traditionally, traditional bank, what they will do is they take the money they can loan out. They loan out to business, they loan out for mortgage and so on. But for Silicon Valley banks, because they can't really do that much of lending. So what happens is that they take the assets and they go and buy like treasuries. If you're very risk averse, you can just buy short-term treasuries. If you can take a bit more risk, you can buy the 10 years one, even longer one. And you can buy mortgage-backed securities or basically any other assets. It's like you take a bit of risk, then you get higher returns. And you have to remember back two years ago, the yield curve is what we call the upward sloping yield curve, meaning that if you invest in 10-year bond, you get higher return compared to a 5-year or 2-year bonds. So that's why there's an incentive for them to invest longer and take on what we call the asset liability risk, meaning that now your assets is longer, your liability is like very short because your depositor can demand their deposits anytime back, right? So assets longer than liabilities. And when the interest rate goes up, right, all these long-dated bonds, their fair value actually drop. So this is the risk that they are taking. But this is all of this complicated by the accounting, because you can classify into held to maturity versus the available for sale. And I think bulk of their assets is classified as the held to maturity. So even if interest rate goes up, right, the value of the bond on their balance sheet stay the same. It doesn't move. So that's why you don't see the problem if you just look at the balance sheet until suddenly now everyone realized that actually the fair value of these bonds is like much lower than expected. So that's the problem.
I wanted to chime in here, right? The other time they were saying that, let's not forget, I think a lot of people like to say accounting is the language of businesses, right? I just wanted to kind of remind everybody that accounting is actually a set of rules that are created by humans, and humans are fallible, and accounting is always a work in process. So I kind of have an accounting background, but I think long story short, things just keep changing because we realize that there are more and more loopholes and how things are being manipulated in the financial world, especially people that have vested interests. So I just wanted to say that even if you look at balance sheet, the funny thing is I think in Q4 they just reported, nobody said it was an issue. Then when suddenly something break, then everybody started saying that, oh, it becomes an issue. Yeah. But I think circling back to this idea of talking about investing in banks, right? So banks are highly leveraged companies. So meaning the entire business model is predicated on them leveraging on people putting in money and they try to earn the spread. So then I think the leverage is at least, if I'm not wrong, it's between the ballpark of 8 to 10 times, meaning they hold 10% of the capital. And then let's say they have 10 million, they leverage up to 100 million, and then they try to do things like loan out, buy treasury bills, whatever. So actually, if you come to think of it, if everything is fine and then the economy is doing good, nobody cares. And then when something breaks, then you realize that I think there's this Buffett quote, right? You only know who's naked or swimming naked when the tide goes off. So with this context, I just wanted to pass the time over to Eric. Why are you still invested in banks? And I know you do own banks in your portfolio, right? Like, what's your thought process behind it? Are you not scared that it's a very leveraged product or financial instrument?
Okay, so I don't know whether you guys still remember, like my DBS, I basically bought it like when COVID. I bought it just before COVID, and then after that, when COVID hit, and then it plunged quite a bit, right? And then I bought some more at about $18, and then I didn't buy a lot lah. I was very, very scared at the time. Like so when the whole market rebounded, right, and then when it hit about $30, I sold off enough so that my remaining stake is essentially FOC. My remaining stake is like the profits from that first two buys. So essentially I'm letting it roll lah, like it's free money. It's just there collecting dividends. So if you ask me if I'm like afraid, not really lah. But if it is like the size of my Tesla, then I will be a lot.
But I think the thought process is more of like when you buy in, which is when it was crashing down, right? Yeah. Are you not scared that the system is going to break? And because banks are naturally leveraged, right?
Yeah, a little bit. Obviously, there's a lot of fear because the market is irrational, But on the rational side, right, I'm thinking like, okay, so our 3 local banks are actually overseen by MAS, which historically, as far as I know, right, they have a bit more stringent kind of like tier 1 or tier 2 capital. I can't remember which one was it. I think basically they have a more stringent framework to ensure that they have enough buffer. In case the shit hits the fan, they have enough buffer, and there's a backup plan for the buffer and a backup, and backup. You know, like we are super kiasu, right? So they have a lot of tier 1, tier 2, tier 3, whatever capital. They are well capitalized, I would say, the last time I look at it. But after I've sold off majority of my stake and then it's all free money, I'm like, whatever. you can crash down. But at the back of my mind, I have this backstop. I don't know whether is it a fallacy, but the backstop in my mind is, okay, they have actually our CPF money. So if anything happens, there's still
that's very dangerous. What do you mean by CPF money? Why DBS can touch CPF money?
I don't know, like they are one of the 3 banks that can, access to the CPF money, right? Like if anything, that
I think that's very, very, very dangerous.
A lot of
very
liquidity.
Claims.
I'm not saying that they will misuse it. I'm saying that if suddenly there is a need for liquidity, so to speak, they can draw, and basically DBS, POSB, right? They are like the biggest deposit base in Singapore.
Yeah. I think here comes the differences, right? Because at least for Singapore's case, I think the 3 probably will never fail because they're I wouldn't say they're state-owned, but they're state-backed. State-owned and state-backed is different. Yeah. Then given that context, right, actually I wanted to ask also, Kelvin, do you have any interest in owning banks at all, like the Singapore banks? And actually, if we look at their performances, right, I think they've done pretty well over the last 3 to 5 years.
Eventually, yes lah. I think the reason people buy Singapore banks is mainly for the dividend, right? Capital growth, I don't think it's there. Sorry to say that. Yes. I
think DBS got triple though. DBS got $10+, then it went up to 30 something now. I think got double or triple. Better than a lot of the growth stocks, at least for the last 2 years.
Yes, but I can also say the same thing about REITs. And REITs, I think, have a similar dividend yield compared to DBS. So and the thing about dividend stock is that you don't buy mainly for the dividend gain, you buy for the dividend yield and the rise in dividend yield over time. So it's like killing the golden goose. If you're going to sell your property now or your dividend stock, where are you going to get your passive income from? So I will only be looking at the dividend yield. Then on dividend yield side, there's no difference compared to REITs and banks. So the only reason you will get banks is to diversify and to capitalize on that Gupta Sons, that how good he is in managing the banks.
Actually, you think about banks, right? Although we tend to laugh at them saying, okay, banks, you get what, 4%, 5% dividends, very low return. Actually, like just now, Chicken, you also mentioned about the leverage, right? It isn't that hard to imagine how the business model works, because what they do is like just spread business. So their assets yielding more than their liability side. So let's say the spread is just 1%, and then you do a 10-to-1 leverage. That's how you get your 10% return on the capital. And if that 10% can persist for long and you don't do crazy stuff, eventually you get that 10% over 7 years, like the rule of 72, right? Over that 7 years, you double your money. Another 7 years, you double again. That's how you get 4x return already. So it isn't that hard. It's just that because of the leverage nature, if they done something wrong, like in the case of SVB, they can just go under within like days, right? Like essentially just 2 or 3 days, they are like wiped up altogether. Yeah, that's my point on the business model of the banks. The leverage is there. And I want to circle back to just now, because Kelvin, you asked about the FDIC took over, why didn't involve taxpayer money. So just a very quick one, like how's the mechanism work is that now FDIC already taken over SVB Bank and another bank, right? Signature Bank?
Signature Bank.
Yes. So they took over. And then what happened is they will just unwind the business. So they will just take over first. And on the asset side, the balance sheet, right, they will sell whatever that they can sell. And then they will just pay the depositors. Once you pay off already, let's say if it's because we don't know how much those assets worth when they sell it. So if they are able to pay all the depositors, then that means nobody will take a loss. But let's say if it is not enough, like they liquidate all the assets, still not enough, right? They will use the fund in the FDIC to pay for this first. Then after that, right, they will just do another raise to charge all the banks. That means charge a higher insurance premium to the banks and replenish back the amount in the FDIC. Because FDIC is essentially like a sinking fund. So every year they collect money from all these member banks and then they just build a fund there. But they are not going to wipe out and rebuild against. What happens is that they can use it first, but immediately after this settle down, they will just increase the assessment and just get back the money and replenish.
So the logic here is who's going to pay? At the end of the day, it's the fellow banks that are going to pay. So like JP Morgan, Citibank.
Correct.
And then all the
banks.
They're just gonna take it. Like
it's part of their operation, expenses. So they want to raise the margin of their products to recoup back. That's their problems. That's the one.
Yeah. So in the end, it'll trigger back down again, right?
Yes.
Okay.
But it's not direct because you need to understand. For example, like what are the cases where it is really taxpayer pay, right? Say for example, this round is not SVB. Because SVB is still considered small, although their asset size is about 200 billions. Imagine this is JP Morgan failing, right? Actually, FDIC, they cannot do this kind of announcement because I don't think they have enough money to bail out the larger bank. So in that case, right, they will have to ask either like Federal Reserve or Treasury Department to step in to bail out the banks. If not, it will become a systemic issue.
Then there was this discussion of the Fed doing this bank term funding program, right? So is this considered flushing money into the system, or is this considered QE, or is this just a life buoy just to throw at the safe whatever they can?
I think this one we will consider as a life buoy, like you mentioned. The reason is because now whatever problem the SVB is facing, actually other regional banks, the smaller one, if they taking similar kind of risk as SVB, they also have similar problem. So what happened is that let's say other smaller banks that people thought that okay, this bank ABC might go under, then they will be bank run again, right? So how to avoid this bank run is to make sure all these banks have enough liquidity to pay the deposit if required. But how do they get liquidity if their banks also if their assets also tied up in longer dated HTM bonds, right? So they also face a similar problem. So Federal Reserve said, okay, if that's the case, you just post your bonds with us as a collateral, and I lend you money, and you can use the money to go and pay out the withdrawal. So essentially, they won't need to sell. Say for example, I have a bonds, I bought it at $100. Now it's worth 80. It's suddenly everyone just like bank run on me, right? I have to sell the bonds, and when you need to force sell, it can drop from 80, become 75, become 70, become 65, that kind of situations, So what happened now is that, okay, I don't need to worry anymore. I can just throw the bonds to Federal Reserve and then just take a loan from Federal Reserve and just pay the withdrawal. So that is it can address the bank run issue, but it still doesn't address the solvency issue because even though you can get a lending from the Federal Reserve, you still need to pay the cost of lending. And your solvency, let's say, or your asset and liability already, asset already lower than liability. What happened is that moving forward, you will still need to pay, like your lending costs, the one that you paid to Federal Reserve is higher than how much you can get from the bonds that you post there. So there will be a negative hit to your net income for the subsequent years. So it addressed part of the issue. It doesn't address the overall problem. The overall problem is there because their assets is already lower than their liabilities. So quite a lot of moving parts. I would say that to conclude this part, right, is that at least from the US government, Federal Reserve and so on, they did what they can to address the bank run issues, the bank run, the risk of bank run. But whether this one is like free money to shareholders, I don't think so, because like SVB case, right, they just wipe out, right? So you can see that Monday, the share price still continue to tank, right? Because you imagine anyone that take on risk in this sector, it could be like, you do some lending to banking sector. Now suddenly you see your friends who lend to SVB now just wipe out. You also scared, right? So the fear is still there.
I think on the topic of fear, right? I think during the weekends as well, was it the weekends or on Monday? I think USDC started a depack, right? Like I think even in the crypto space, there's this cascading effect on whether everybody is just trying to run away from all these even stable coins and stuff. So maybe Kelvin, you want to share like what exactly is going on with like USDC and still can hold stable coins?
Still can hold. I've always tell people like, why are you holding stable coin? Probably the reason is because you can get 10% yield on stable coins. In the past, I thought this will work lah, but eventually this doesn't work. So if you are holding stable coins, you are risking losing 100%. But now it seems that USDC is back to its peg again. Same for USDT is also safe. It looks safe lah. So,
But what was the fear though? Why did it even depeg in the first place?
so it seems like the company behind USDC, the Circle, has like 3.3 billion exposure in the bank lah. Then if the bank was to collapse, USDC can't pay out the money if needed. The investors can't redeem the money one-to-one. So that's why they started bank running on USDC. Yes. Then when the Fed announced that they will do this bailout, USDC magically went back to its peg again. So it seems like USDC is back to normal again. Every business is going normal. The crypto market is mooning all over again. But for me, I still don't like the risk of losing 100% in stable coins just to earn that 10% lah. That 10%, just invest in any good company, you can easily get that 10% already lah, without losing 100%.
Also, the risk return trade-off also doesn't make sense, right? So imagine, let's say, like 2 years back when you put your money in safe investment, you get 1%. You put in all these stable coin, you get 5%, for example. You get like 5x more.
20%.
But now risk-free, you get what, 4%? And all this, I don't know what's the yield farming that you can get from stable coins. Is it like what, 10%? So it's like you can potentially get like 2x more. Like risk return wise, I don't think it makes sense. Yeah.
Hey guys, do you know what's a good broker to buy stocks?
Oh, I know, you can use Moomoo.
Why?
A few reasons. Moomoo got low commission, so you save a lot on trading fees.
Not only that, they also let you easily keep track of the company's news and announcements.
Oh yeah, they also let you easily analyze companies from both the technicals and fundamentals to help you make better decisions when investing in company.
Wow, so good. But they got give sign-up rewards or not? Or any sign-up gifts or not?
Got. For the first reward, when you deposit $100, you'll get $2 cashback for daily for 10 days.
And for the second reward, deposit 2K and perform 2 buy trades to get a free Coca-Cola stock worth $80.
And the ultimate reward, deposit 10K and perform 7 buy trades to get a $108 cash coupon.
Wow, so good. So if you're interested, you can always sign up with the link below. And as always, thank you, Moomoo, for sponsoring this video. I think on the discussion of this whole idea of like now Fed tightening, right? And then there are two sides of the camp. There's a bearish side and then there's the bullish side. So the bullish side saying that inflation is coming down, the Fed is going to be forced, the hands are going to be forced. They need to start to lower down the interest rate or start to pivot soon. And then on the bearish side, they're saying that this huge increase in interest rate in such a short period of time, something is going to break. So do you consider like SVB or all these treasuries just suddenly going, like, because the price need to go down to match the yield, right? Is this considered something breaking? I just wanted to get Eric's point of view, because I know a few of the very big personalities are saying that, oh, something's going to break. But then when SVB collapsed, they say, see, I tell you, I predicted already. So I just wanted to get your thoughts on how you look at this whole shenanigans.
I think like the way that I see it, right, the big picture is still that the interest is going to be high. It's still going to be around 4%, 4 to 5%. I'm not sure whether you hit 6%. I think someone came on and said, was it, who was it? Came on recently.
Was it Sean?
Yeah. I think Sean said 6%, right? He expected to hit 6%. I think this year-wise, 2020, I expected to hover around 4 to 5%. Basically because things are starting to break. Because the interest rate is like, I think it's at a level, if you keep it there, right? Even people like locally, right? You see that they've taken out fixed mortgage and things like that, like just last year or the year before, right? If the high interest keeps on being this high, this level for the whole year, I think these people will start to have some fears, right? Refinancing their mortgage and all that, and things will start to crack. And people are basing the fact that, 3 years time, most likely the interest will come down. So I think like if the inflation is still stubbornly refuse to come down, then the jobless claim doesn't really spike up a lot, and the employment data is still strong, I think the Powell has no choice, right? He either have to keep it there, at least minimally, to bring the inflation down. He can't really bring it up much more faster. What I see, like things are starting to break. You hear a few plates falling to the ground. Piang, then okay. I think there was this senator that's asking him, hey, you're going to make the interest so high and keep it high until things break, right? Until like there's like massive unemployment, right? Then the Jerome Powell say, no, we're just trying to bring the inflation down. So he keep trying to skirt the question. But essentially what the senator was trying to push him to say, like to lead him to say that, yes, I want to make it until the economy crash. But he's not going to say it, because that will incriminate himself, because that's not his job to do. But there's something that he has to do. So like, okay, so this is the situation, right? That he's in a dilemma. He has to do these things, but he cannot say he's doing it.
Actually, I don't think there's a lot of dilemma there, because basically they have dual mandates. I'm talking about Federal Reserve. One is they want to make sure that price stability, meaning the inflation should be low. Another one is make sure that the unemployment rate stay at a healthy level. Okay, so I mean, at different period, they face different kind of problem. Okay, I think let's say if you go back to 2-3 years ago, we have very low inflation. That's why they can press interest rate to zero and just helping the economy to stimulate the economy, even stimulate the inflation. So that's why interest rate at zero. Now it's on the opposite side. Is that now inflation is very high, but the job market is very good. So they are okay to keep on raising rate until the unemployment rate shoot up. But we are still very far away from that. Meaning, if you look at the job market, everything looks still okay. So I think when they raise rates, right, it isn't that hard of a decisions. It will be very hard decisions when, let's say, unemployment rate now just shoot up to, let's say, 8%, and inflation just stay at, let's say, like 6%, or even go up to 8%. Then they will have a huge dilemma, which actually happened in the past. I think in the 70s, there's period that you have all this slow growth, high inflation period. That one very, very hard. Either they cut interest rate, also die. They raise interest rate, also die. Do nothing, also die. So there will be period that's hard. Yeah.
Bundi, you're saying that because now it's not, right? So because CPI data just released recently, so it came in at 6%. Correct. So the trend is intact, saying that it's going down. But I think even if you look at specific line items, I think some of them are saying that some are lagging indicators like the shelter portion.
Yes.
So since we are looking at like employment numbers and we are saying that, hey, things are still looking good. So maybe we can take in some predictions on what y'all think the Fed is going to do in the next meeting. 0.25, 0.5, or not going to do anything?
It'll be
0.25.
25. Yeah, 25 basis point, and then no more hike after that. At least that's what being priced in currently.
Yeah, so that is being priced in. I want your opinion. I don't want what's priced in.
Yeah, I think it will continue to get up like 25 and 25 after that.
So you don't believe we'll 25 then stop lah?
No, I don't think it will stop.
Okay, then Kelvin?
So before I answer that, just last week before this whole bank collapse, it was actually priced at 50 basis points. Then right after this bank thing happened,
people think they're forced lah.
It dropped to 25, right?
It dropped to zero first. Then inflation came out, it went up to 25 again.
Yeah, so the whole reason it went to 50 was because of last month's CPI, where it actually showed that it didn't slow down as fast. Then now it showed that it's in line with expectations. So I'll be similar to Bunti. It's most likely 25 already because inflation is going down as expected. But they can't do zero because inflation is not slowing down yet. The reason it's slowing down is because the Fed is pushing it down. So if they try to stop, then inflation will go back up again. So they can't really stop now.
Yeah, at least a couple more months. Then we see whether what else will break. Then decide.
This is the upcoming meeting, right? Then Kelvin, do you think they'll still continue hiking after this 25 that's gonna come?
Wow. I have to see the data. So it depends on...
No, it cannot house back cannon,
Sounds like Jerome Powell now.
Yeah. What C data? This kind, we are in the prediction game.
Yeah, what prediction game? Okay, my prediction, most likely it will... Wow, it's a 50-50 I can't tell.
Okay, he said his prediction already. 50-50. Okay, very good.
Okay, what about Eric?
Yeah, I think it's 25. lah. As of now, I quite agree with Bunti because they want to bring it down to 2%, right? The inflation. So basically you need to slowly bring up the interest rate. And they can't do it any faster because things are already breaking. So they will slowly crank it up, slowly inch up. And then you cannot say they zoom up so too fast, but you also cannot say they do nothing. So at least they crank a little bit. So end of the year still okay.
The pattern will be like stock market, you know, they can do 25, pause a while, 25, pause a while. But when they drop, it will be like 100 basis point drop. Because that will be like, you know, period where really something big that just broke out.
Do y'all see this Silvergate SVB, right? Do y'all see like sort of like Bear Stearns kind of prelude to Lehman Brother kind of thing? I think Mr. Lu said something like this, right? He said it smells like Bear Stearns. Then Lehman Brother is like looking like it's gonna come up soon. Like I think if I don't remember wrongly, the time was about 5 to 6 months after Bear Stearns collapse. So I don't know. What's your take?
I think this one, there's some truth in it in a sense of this bank, this SVB bank collapse, right? It won't cause much contagion. And even all the regional banks, I don't think it's like as big as an issue because they already do things to address that. But I think the next so-called the Lehman's collapse, right, will be something that we are even not aware now. Because there's a risk hidden here and there. Like these SVB things, also we never heard of these things like 1 month ago. There are people who saw it, of course, those who dig very details because based on the disclosure they can see that, right? But I think the next big one where we don't even know what is that. If it is that easy, then all of us become rich already. It's just not easy. It could be, like brokerage business or whatever, right? Like BlackRock suddenly shows that they got problem. Wow, BlackRock few trillion can have this kind of problem. I never expected that. I mean, this kind of big shocks that will become the next Lehman. I won't say it is coming. I'm just saying that if there's another big thing, right, it won't be like all these regional small bank, right? Because we know that for all these small bank, right, if there's any problem, right, FDIC take over, they just do whatever they did to SVB. I think they can address it. If they can address it, right, it won't become like a Lehman Brothers situation. Lehman Brothers situation is that the problem is there. It's a big problem. No one has capacity to solve it. That's why everything have to like pass to like US government to address it because it's really too big of a situation. And now, as of now, I would say I can't see any big problem like this now. Yeah, but it was always be hidden until it suddenly surfaced. So like, who can do all this digging and go and find out these things, right? Yeah.
But you remember there's this Deutsche Bank, Credit Suisse. Do you remember like a couple of years back, they always have some issues and their share price has been tanking for.
But there's a scandals, There's a scandals. The scandals range in the range of like corruption, all the very weird stuff. Because there are many case studies like in finance school also. But I don't necessarily think that they will go under because as long as you are like part of I forgot what's the term they use. Like there's this consortium of banks that cannot be touched. So they claim it to be too big to fail. So meaning when they are in a very risky position, the governments usually step in.
Systemic banks.
They're considered systemic
but
banks.
Their capital structure also not very good. They are suffering, I would say.
So shareholders, they will socialize the cost to shareholders. But then they can't go under, meaning like they technically, theoretically, they can't go under. But doesn't mean shareholders will earn money in the meantime because they are not bankrupt. If you get the drift.
Let's put it this way: if they go under, government will step in for big banks. Government came in the form of either they outright take over or they force another M&A, meaning another bank will absorb them so that they can. I mean, at least that doesn't lead to contagion because all these big banks, right, is huge balance sheet. You don't know their counterparties. If they suddenly collapse, the other counterparty, you don't even know who are they because like so many business is also tied to them, right? So if it's really like one big domino fall, right, then you don't know who's below that will just like die. That's why they have to take over. They can't easily unwind. But for SVB is easier.
When you say take over, right, the government step in to take over. Are you referring to they pay out the people who deposited there, or they step in to like bail out the shareholders? Because there's two sides.
Yeah, there are many forms. One form is just like, okay, now Treasury just become the shareholders. They weigh in, they take over the business, then the bank continue to run. But the shareholders now is the US Treasury, for example.
So the shareholders are so-called like bail out.
Wipe out. It could be wiped out, can be bailed out depending on the structure.
I don't think will be bailed out though. Should be wiped out though. If let's say
for example,
a complete takeover.
If you look at 2008, right, there are some banks. I remember like Bear Stearns, they essentially collapsed, right? But it's not like they unwind it. I think there's some M&A going on. But to engineer M&A, you need to have like the buyer willing to buy and the bank's shareholders willing to sell. Say for example, like you are the shareholders of SVB and government say, okay, cannot. I want JP Morgan to buy SVB. Actually, the shareholders of the bank need to agree, and they need to get some payout, right, to agree. If suddenly I force you to sell your shares at zero, will you agree? You say no, I don't want to sell. If you don't want to sell, right, then what happens is that there's no transaction. So you will just say, okay, anyway, I get zero. So why not I just drag on until I collapse, then let everyone die together with me. So it could happen something like that, That is what happened with Lehman. So that's why it's a big thing when it collapses. Yeah.
So I'm just thinking like you guys were saying like long dated treasuries, right? Like the price is coming down, right? If I didn't hear you wrongly, price coming down. So
sorry, price of what? Price of bond?
Long dated treasuries.
The price of the bond?
Yeah.
Actually, the price depends on the yield level. I think after last Friday and Monday, yield dropped slightly. And then
so price
went up a bit. Not a lot. Yeah.
So my question is, will the other banks, right, that they are holding such bonds, right, will they also like in a panic want to like sell these bonds that they bought, these long dated bonds?
Actually, most of them similar to SVB is that they already put it in the held to maturity. They can't sell. They can't sell. And they don't need to sell because they can get to the one that Kelvin just mentioned, the Federal Reserve term loan, BTFP. Yeah.
Okay. So it means that like there will be no pressure on these.
Yeah, no pressure to sell the long dated bonds.
Like what I mean is no pressure in the market, the secondary market, that will push down the prices and then destabilize the market.
No.
Okay. Just thinking what might be a contagion from that.
No, if we can think about it or if we can predict, right, then it wouldn't have much issues to the market because it's priced in.
I need to think of a more like one shot kill everything quote.
Yeah, I think all these things, there are so many people they do all this digging, they can see it. Say for example, there's this hedge funds, right? I think it's called the Raging Bull. So what happened is that I think January they already raised this problem about Silicon Valley banks, and they're having a short position on the bank. So it's not like something that is totally hidden that no one see it. I think there are people who saw it. It's just that it's not under our radar. I mean, US they have like more than 100 small banks like this, right? So who go and dig all these details, right? Yeah.
Oh, by the way, for whatever that's worth, I'm also a China bank shareholder. I think China banks are okay because it's state owned. It's not state backed, it's state owned. So I'm actually of the personal opinion that we shouldn't socialize the cost. So I believe that many of the banks out there, at least the big ones, should be either state backed or state owned. Because at the end of the day, it feels to me like it's a utility. It's not really you mask this utility into a profit shareholding structure, and then you get the shareholders in, and then you complicate the whole mess, and then later 倒闭了, then you start to blame people, and then you socialize the cost again, which I think is quite weird. But at the end of the day, I think for China banks, I'm okay lah. I mean I'm okay with the risk, but you do need to still understand that it's a very highly leveraged business, and because a majority shareholder is the Ministry of Finance of China. So don't need majority shareholder to agree, because the government and the bank, they just and then they say, okay, you do this, you do that, then they just sign the contract. So yeah, that's that. But
the
anyway,
risk,
I see Bunti.
Yeah, the risk of dilution is still there, and the leverage is still there. Just need to remember these two. Yeah.
Yes, correct. I think risk of dilution, the classic example is Citi they went from like what 200 to $1. So you think drop 90% can still drop another 90%. So that's the risk there. But I think generally speaking, it's a little bit different. I think it's more nuanced when you compare the US to Singapore counterparts, to China counterparts. They're all playing their own game. So just as long as you're comfortable with the risk, it's fine. I'm not advocating to buy banks, by the way. So yes, hope you guys enjoyed the discussion, and we'll see you in the next video. Goodbye.